let's go ahead and jump in here. Wall Street has been enjoying a pretty nice rally lately, honestly, but one strategist is saying don't say that this is here to stay. Matt Maley tells CNBC the market honestly can't stay at these levels.
Even if we don't fall into recession, when you got a market that's trading at 19 times earnings, it has to come back down to fairly valued. Remember what happened in 2000 to 2003. We had one of the mildest recessions in history, and yet the stock market still got clobbered. Why? Because it started at an incredibly high valuation level, extremely high valuation, and it just takes much longer for it to get back down to fairly valued.
So, guys, do you get into this discussion with people that come in, or should we be more concerned with long-term planning than short-term rallies?
Well, it's definitely been a topic of conversation. In fact, in our February investment committee meeting, that was one of the topics that we talked about is, short term. There's a lot of news that's out there that could talk about how the market could go down coming up. We had a little bit of a sell-off during that 1 week, and then other times people were talking about how the market's just set to rally back up like it's been doing from October. So I think, when I'm looking at long-term planning versus short-term wins, I'm going to go back and, first of all, reference an article that was written by Warren Buffett, and as many of you know, probably one of the most successful investors of all time. Mm-hmm. If you get an opportunity, what I encourage you to do is go on Google, and you can Google this article. It's by Warren Buffett. It's by American IM. Now, he wrote this article back in October 16th of 2008. So if we go back into that time frame, right, the financial world was in a mess, both the United States and even overseas. There was so many different problems that we're having with the meltdown in the financial markets. And when we look through this article that he wrote, a couple of things I underlined that stood out to me in this article is, one is he said, a simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. And then he goes on to say, to be sure, investors are right to be worried of highly leveraged entities or businesses which have weak competitive positions. And then he went on to say, let me be clear on one point. I cannot predict the short-term movements in the stock market. Now, Chaz, you've been at a lot of different events that we've been doing here lately, and one of the questions I asked the audience is, hey, from where we're at right now within the stock market, only one of two things can happen first. Either the market rally that started back in October continues on, the market goes back up 20%, and this would be what that closing number would be, or that was just a short-term rally in a bigger bear market, and then the bears are going to come back to rear their head, and the market's going to sell back off another 20%. I asked the audience which are going to happen first, and from my unscientific data, what I would say is roughly 70% of the audience probably raised their hand that say down first. And so if you use this article that Warren Buffett, wrote about by American IM, from the date that he wrote that article, October 16th, 2008, through March 9th of 2009, so just a couple of months later, the stock market was down 28%. So had you read his article back in October of 2008 and went and purchased the market, I think maybe a couple months later you'd be thinking, what an idiot. Mm-hmm. What kind of advice is that? My account value is down and the market's down 28%. But if you look at it from October of 2008 to October of 2009, that 1 year time frame, the market had improved by actually 14%. Mm-hmm. And then if you look at it from October 8th to October 22nd, so looking at it from, again, October 2008 to October 2022, the market, the S&P was up 280%. So, when we're looking at long-term planning versus short-term wins, I think, again, the pullback that we had in the market can create some great opportunities for people that have time on their side and not have to worry so much about the short-term predictions of the market. What would you say?
I would agree with that. I mean, I think last year the silver lining to the carnage that was the market is, again, the fact that amongst that rubble, there are a lot of gems. It's just, it's our job to try to find those, and it's been extremely difficult because of all the competing viewpoints that are out there. Some, as you said, Nolan, feel that interest rates are going to continue to go up, and that, again, the market's going to sell off another 15 to 20% from here. There's another camp that says that we may actually have already caused some significant recessionary pressure on the economy, and it's going to be not a soft landing but a hard landing, and then the government is going to have to kind of reverse their course and start taking interest rates back down again, kind of put us into that quantitative easing space where just a few years ago interest rates were effectively zero, and in some countries even negative. And so nobody really knows, obviously, but I think one of the bigger risks that we face as investors and sometimes as investor financial advisors is that we tend to over extrapolate, and focus more so on the short end, in expectations that these inflationary trends are going to continue forever. I mean, I think that's what kind of got us into trouble with the recent downturn, is we thought that these low interest rates, this free money, this money tree that was out there was going to be around forever, and it wasn't. And then in COVID, during 2020, we thought that, COVID, meeting in person is over. Never going to be doing anything in person. We need a lot more cloud computing technology. We need new technology and computers to be able to interface electronically. And then a year later, it's somewhat solved. So the bigger takeaway that I have is don't extrapolate out these big macro trends too far. This too shall pass. We are going to come into a different time when the market is not going down. It's not been like a yo-yo, and it could be sooner than we think. So you want to make sure that you have some flexible assets. You have some ability to take advantage of those trends when they do change.
Yeah, and I think, if you look at it short term, what you want to be doing short term is you want to look at, again, where maybe some of those opportunities are right now. Going back to that article, again, what he talked about in '08 is, one of the things he said is, to be sure, investors are right to be worried of highly leveraged entities or businesses with weak competitive positions. So I really think that rings true today. I think, when you're looking at the investments that you own, we still like companies that people use every single day. We like companies that, have good cash positions, low debt, high return on equity, unique competitive advantages compared to their competition. Those are the areas to take a look at. When you're looking at it more short term, the other thing I think you want to do is look at maybe thinking about the strategy of having a gas pedal put on your portfolio. So many times people go from kind of one extreme to the next, meaning that they'll either have all their money in the market or they'll get panicked and they'll get all of the money out of the market. And that's very difficult when you get in or out. But the strategy of having a gas pedal means looking at your portfolio and being more adaptive to current market conditions. So, when the conditions look bad, things technically look negative, what you can do is lean off the gas pedal. You talk about investors, they overreact. So last year, as you've heard, the bond market had one of the worst years on record. If you look at some of the bond prices that are out there, there's been a lot of bond categories that have been oversold. So I did a show. You can check it out on our YouTube channel. Again, just type in America's Retirement Headquarters on YouTube. Check out the show that I talked about, the 60-40 portfolio and our outlook for 2023, because I think there's some good ideas. And again, that could be another area where, some of those values have been pushed down in the bond market category that do create some opportunities. There's also opportunities within the market as long as you're selective on what you know and what you own and what you put into your portfolio. And I guess, if you're listening to the show and you've stuck with me that long with learning about long-term versus short-term and which one wins, just know if you're not sure and you want a second opinion, whether you have a 401k or whether you're just looking for a second set of eyes, the next step to do is to get an investment policy statement, to have an independent portfolio analysis done. Take a look at the independent portfolio analysis. What we can do is we can take your investments and we can slice and dice and go through and be able to break it down to you in terms that you understand, kind of show you where we think some of the strengths are in the portfolio, maybe where some of the weaknesses are, and give you feedback on how to optimize your portfolio. So if you haven't got a portfolio optimization report, I would encourage you to give us a call. That's the best way to know what to do now to make sure that your long-term plan still wins.
As you guys both said earlier, if you've got time on your side, you can withstand the ups and downs of the market. But the show is called America's Retirement Headquarters. This is home of the Retirement Guys formula. Many of the listeners are approaching retirement, if not already in retirement. And so time not necessarily going to be on their side to just kind of wait it out. So having a more dynamic, a more objective approach, and that can be a little bit trickier to do when it's your own money that you're working on. But having, that independent portfolio analysis done, that portfolio optimization report can go a long way to hopefully giving you some comfort and showing you where opportunities may lie right now with the market conditions. And so it's real easy to get started. 419-794-3030 is the phone number. Once again, that's 419-794-3030. You can go online to arhq.com. While you're there, click on the events tab at arhq.com and find one of the upcoming financial events that's going on, and feel free to register for that as well.